Hello and welcome to KYC, Know Your Company. Today we're going to focus in on Morepen Laboratories. Interesting play. It's an interplay between pharma as well as medical devices, has good revenue distribution across the world. But let's quickly zoom in as to what the company does. Morepen Labs, it manufactures, produces, develops and markets a whole host of products. Let's talk about them. One is APIs, which is Active Pharmaceutical Ingredients. We'll talk a little bit about what APIs are. Branded and generic formulations is the other piece that they do, and home health products is the third piece they do. So if we were to categorize into two baskets, one is pharma, one is medical devices, but otherwise these are the three different streams that they deal in. Let's talk about active pharmaceutical ingredients first. What's an API? It's a substance within a drug formulation that produces the desired physiological effect. So for crocin, it helps you alleviate fever. Basically, the drug which allows you to do that is an API. It allows for pain relief, for reducing inflammation, or targets a specific pathogen in order to repair whatever is the concern in your body. In terms of quality and potency, that really determines how good the medication therefore is. So API is critical in the drug to ensure that the cure that you are looking for is actually being found. That is what an API is. So Morepen manufactures API. It's a leader, especially in anti-asthmatic, anti-allergy and cholesterol related APIs. These three APIs it's a leader in terms of supplying. Now let's talk about the branded generic formulation. This is where better margins start to come into play. This is actually developed after the patent for the original drug expires. So once the original drug's patent expires, you will have all sorts of generics which will enter the market. Within that, branded generics will always command a slight bit of premium. So you might have, for fever, you might have a Dolo, you might have a Crocin. Both of them are branded generic drugs. That's what Morepen has also ventured into. And they brand it to ensure recall, of course, and therefore customer preference. The last piece is home healthcare products. So, okay, branded generics, Bernol is one of them. The other one is Lemolate, which takes care of cough and cold. So these are a couple of products within the branded generic space that Morepen does. Now, last one is with regard to home health products. These are medical devices which the company sells. It manufactures and sells several devices, and some of them on your screen. It includes thermometers, pulse oximeters, blood pressure monitors and the like. So a whole host of products is what they do, including glucometers. These are just some indicative of the various other products that the company does. Now in terms of business split, it does 70% pharma currently, 30% medical devices. That's how the business is split up. Where do they sell? Let's pull out the geographies as well, and that's how they are split up. 30% India, 70% rest of the world. Asia plus India is roughly 56%. Europe contributes 21%. USA is just about 16%. That might be impacted by tariffs as well. And the rest of the world is just about 7%. A higher share here will ensure better margins as well. So something to keep in mind. It manufactures and operates 2 manufacturing units out of Himachal Pradesh. That's where all of your manufacturing happens. But so we'll try and break this down. Of course, we'll break this down metric wise as we always do. And let's quickly talk about those metrics. We'll first talk about the income statement, the balance sheet. We'll also talk about cash flow, return ratios, shareholding, street cred. We'll talk about valuations, and last off, we'll speak about the outlook and what the guidance is. And joining me today to help me break this down is Hiral Dadia. Of course, Varsha Chandani generally covers pharma but is absent, and therefore I'm in the esteemed presence of Hiral. Hiral, let me allow you to start off with income statement.
Thanks, Harsh. I mean, it's an interesting company to watch out for. Reason being is, you know, from medical devices, they've moved to APIs and other pharma products, and now All of that accounts for nearly 70% of the top line, as Harsh was mentioning. But let's quickly look at the financial matrix overall. Now, if you see in terms of the revenue, from 1,547 crores in FY22, it's moved to around 1,690. So in terms of the revenue growth, it's around 19.5% in FY24. No major, I mean, in fact, it's taken a downtick if you have to compare to a FY22 number. But let's be precise that, yes, their foray in terms of the medical pharma business is what probably is leading to these kind of numbers. In terms of the margins as well, I mean, the trajectory from a 9%, it took a drop to around 6% in FY23, bounced back again to 9%. So if you have to compare the last 3 years, pretty flat, no major changes that have happened on that front. And the profitability, interestingly, is still lower as compared to FY22 at around 97 crores, a marginal 4 crore difference, 4 to 5 crore difference. But, I mean, compared to FY23, yes, it's an upbeat number. So, overall, the 3-year revenue CAGR, if you have to compare, it's at 12%, flat in terms of the profit number. So, that's something which is on a neutral basis. And if you have to compare the 9-month FY25 performance, let's look at that one. Revenue 1,346 crores, EBITDA of around 132 crores, and the net profit number is at around 98 crores. So you might see a marginal uptick probably this time around, and if not, if they have to follow the same CAGR trajectory, Harsh, I mean, it'll be a flattish number once again. So, I mean, it's a neutral number coming in so far if you have to look at the 9 months period as well.
Yeah, I mean, fails to enthuse enough, Hiral, especially on a small base for a 3,000 crore market cap company. You'd want a faster clip. That's what
faster clip on that front. And second aspect is with the trajectory they have in terms of the next 5 years. With these kind of numbers, how are they going to be able to achieve that guidance is going to be key to check with the management if you have to talk about the top line, bottom line and the margin front.
Yeah, absolutely. And we'll talk about that in the outlook as well, and we'll quiz management. Let's talk about the balance sheet. Now, in terms of how that's stacking up, you have around 1,000 crore odd of reserves. Mind you, the reserves of 1,000 crore, while they look very impressive, some chunk of that is also coming due to the fresh issue that they've done this year, which is in, beg your pardon, last financial year. And in August of 2024, they've raised around 200 odd crore. And otherwise, shareholder equity is at roughly 1,100 odd crore in total, including equity plus reserves. Your long-term borrowings are far and few. Short-term borrowings also not a concern. Cumulatively below the 40 crore number for a 3,000 crore market cap company, not really much of a concern. They have around 50 crore rupees in cash. Why have they done the fundraise in August? And this is slightly critical in that sense. They've done it. They've completed the QIP with regard to and trying to push with regard to medical devices and API business on the growth count. So they're trying to, it's growth capital basically that they've raised, and they are also enhancing capacity. So their capacity enhancing plans will start to impact the numbers both on the P&L, which Hiral discussed, in the next 18 to 24 months is what they're saying. December is when they actually kick-started the investment process. So maybe 18 to 24 months from there. But we will ask management on that count as well. So the first two metrics covered. Hiral, cash flow.
So cash flow, again, if you see, it's an interesting number because if you see the net cash flow, they are at around 28 crores, right? And with that, if you have to look at the cash flow from operations, they have turned positive this time around at 73 crores in terms of FY24, wherein the last 2 years, 22 and 23, have been on a negative scale, a negative 60 crore number and a negative 91 crore number. So somewhere the CFO is, the cash flow from operations is positive, but the net cash flow is something which is interesting because from a 28 crore positive number in FY21, they've gone down to a negative number of 5 crores. So overall, again, it's a very neutral number coming in there because now they are raising funds as well. So whether the money is coming in from outside, but what is the business doing in terms of generation of funds is the key aspect over here, because if that is going to be dwindling, you know, where is the money coming in from in terms of business?
Yes, absolutely. So something to be considered and taken care of. Cash flow from operations getting better, but your net cash flow still negative or muted. need to possibly see a change there. Let's talk about return ratios though, and that'll come up. Basically, what we've seen in terms of a trend is we saw return ratios fall off a cliff in 2023. They've rebounded a bit in FY24, but mind you, FY25 has a fundraise in place as well. So you might see return ratios remain capped on that count because there is a fundraise, even though we've seen a bit of a bounce back with regard to return ratios, nowhere close to a 20% number. But when we're looking at possibly the return on equity, also very similar structure. And therefore, you might want to keep in mind that maybe for the next year or two, your return ratios may not rebound back to maybe a 20% number. Therefore, a neutral on that count, while we've seen a rebound, a decentish kind of a rebound, a mid-teens to a higher teens ROC, Hiral, not too bad, but you'd want more from a smaller company. And of course, they're investing capital straight back into the business. So, so maybe something to look out for where return ratios
So I think what you're saying is that the mid-teen number that could come in the next year or two, probably in a case-by-case basis, could be a positive, but a bounce back to 20 kind of a number is not going to be possible.
Looks difficult at this point.
Correct.
Unless there is some significant
and if 20 happens for whatever reason that the management could be confident of, I think then it could be a re-rating candidate then. But
Absolutely.
as of now, you're still looking at something of the possibilities so far. But let's look at the shareholding pattern as well. What's interesting is no major FIs, DIIs are holding this stock. It's remained absolutely stable. I mean, from a 2.08 from an FIs, it's gone up to 1.94. I mean, gone down to 1.94. DIIs have also remained stable in the last 2 to 3 quarters. Public holding has also remained stable, right? So nothing major that has changed with regards to the shareholding pattern. And with FIs and DIIs not having skin in the game as well with regards to Morepen, I think that seems to be concerning for me when I have to look at the company, because I mean it's absolutely dependent on what the public does. Now, whether this 60 to 61% of the public shareholding has the confidence in the 35-36% of the promoter shareholding is what we need to see, because the promoters are confident in terms of the growth outlook. But execution becomes key, achieving that guidance becomes key.
Correct.
So that correlation is going to be interesting, but again a neutral because of no FIs, DIs increasing their position.
Correct. And that too, but also, Hiral, some context, because it's a 3,000 crore market cap company. You wouldn't see too much FI, DI participation in companies that small as well. So if it is a re-rating candidate, you could well see some upside coming from there as well, if it were to re-rate or become a multi-bagger of sorts. So you might want to keep that in mind as well.
Absolutely, and that's the reason why a neutral right now, because
Yes.
if the opportunity is there, you know, the FIs or the DIs are going to jump onto it.
Correct.
So whether that opportunity comes in or not is anyone's guess.
Absolutely, absolutely. So, but interesting play on that count with regard to where shareholding is concerned. Let's talk about Street Cred very quickly. It's down 41% or rather 42% in the last 6 months. The last year or so, the performance has been decent, up 16 odd %. And the last 5 years also, the performance has been decent, up around 243 odd %. So it's been a multi-bag over the last 5 years or thereabouts. What you'd really want to look for, though, in the near term is the kind of pain that shareholders have already seen. The last 1 month to 6 months, we've seen plenty of pain. Even year to date, the stock is down 33%. So it's lost a third of its market capitalization just in the year to date period. Something to be looked out for, especially in the short term, we've seen pain. In the long term, we've seen decent returns. So neutral on the count of Street Cred. Hiral, you want to take up valuations?
It's an interesting play in terms of valuations, because cheapest of the lot, I think, if you have to compare it to a Morepen or a Aarti Drugs, Shilpa Medicare and a Supriya Life, I mean, 22 times, that's the trailing 12-month price to earnings that we're considering. So in terms of valuations and the opportunities and the guidance that the management has given, it will be a thumbs up because it's cheap in terms of valuations. But where from here on, whether we are able to see that scale up happening is going to be crucial. So as of now, the stock looks attractive from a valuation perspective, Harsh.
Right. Interesting now in terms of outlook, because such positive commentary coming through. They're targeting a 5,000 crore top line. For context, they've done sub 1,700 last year. They're targeting 5,000 crores in terms of top line by FY30. The margin, which is sub 10%, is expected to be mid-teens by the end of this FY30 kind of guidance period. They're going to do new products which will drive growth. The new products span across the board, medical devices, over-the-counter medicine, nutraceuticals, all of those. They are expecting growth rate of anything between 10 to 15% in the coming years. They are aiming to maintain that 70-30 ratio in terms of exports to domestic sales, and they are looking at higher margin products to aid profitability going forward. They are focusing in on expanding the medical devices segment and enhancing the product portfolio in pharma and O2C categories, so OTC categories, I beg your pardon. So those are basically the spaces in which they are focusing in on. Let's quickly look at the final rating on this one. Let's pull up all our rating parameters and quickly have a look at it before we speak with management. That's how it's shaped up. Income statement neutral, more asked for from a growth perspective. Balance sheet, cash flow, return ratios. When you're looking at shareholding, neutral, street cred, neutral, valuation, clear thumbs up, and outlook also very, very positive. If they were to actually follow through on outlook, you'd see a largish kind of upside likely on this one. 5.5 on 8 is the KYC rating on this. A 5,000 crore top line, Hiral, 15% margin, 750 crore will be the EBITDA with near zero debt. And trading at 3,000 crore. It's virtually trading at 4 times EBITDA. So likely the opportunity is large. But let's actually go to management, ask them how likely is this.
And then how can you get probably a 6 or a 7 on 8 on a KYC in the near future is the question.
Yeah, they will do that once they start moving towards that number of 5,000 crore. But Sushil Suri, CMD at Morepen Labs, joining us for exactly that and trying to understand exactly that. So I want to first start off by understanding from you what the revenue split will be. FY30, you are guiding for a 5,000 crore top line. How certain is that, and what will the revenue split be like at that point?
Good morning to both of you. So revenue streams, I think you rightly guessed and just heard the little KYC of mine. I could see that. So I think the interesting point here is that revenue streams are growing all the way, whether it is the finished dosage or the medical devices. So I am not saying the revenue mix will change per se, but the growth or the rate of growth is going to be more productive. So if we start from the first part, first thing first, which is our API business. API is our core business. So give or take few 100 crore, a few 50, 100 crore here, and that's a 1,000 crore business. So it will keep growing between, I would say 8 to 10%. At a CAGR of 8%, it had been growing. But on the other hand, medical devices, despite ups and downs because of the COVID, it has grown 15% CAGR. So we expect medical devices to continue at 15% CAGR. And of course, the overall expectation is much more, but 15% CAGR we are still maintaining. And the interesting point...
So I'm sorry for interrupting, but sir, what gives you that confidence? Because the last 2 to 3 years have been difficult. What changes in the next 5 years that gives you that confidence that you'll go 3x on top line?
I'm saying on the CAGR front, I have grown 15% in medical devices.
Sure.
Despite ups and downs.
Sure.
So sometime it was 45%, then it was an overstocking during the COVID time. Next year it dropped. Then again, last year it was 35% growth. Now this year it may be between, I'm not giving the number as yet because the results are not out, anywhere between 10 to 15% this year again. So but CAGR is 15%. So we always see that market inventories change, import, export positions change, but overall, if we keep on year, we are growing, we are okay. In medical devices, the growth, if we particularly talk about, let me complete the whole thing first. And the second opportunity we have seen is in the finished dosage. Finished dosage, last 5 years, we have got a CAGR of 22%, which is, I'm happy to say, which is matching with the so-called India finished dosage market. India market, the big players have been growing between 10 to 11%. The market is now more than 230,000 crores. So I remember when we started finished dosage, it was just 20,000 crore. It is already 10x now. So now the two major drivers, what we are seeing is, one is the finished dosage, wherein we are naturally a new player and we are a small player. We are not ranking even in the top 100 companies. So that is where our one expansion is going. And we are trying to match with the speed of the market. And we have recently gave an announcement also to the stock exchange last week regarding hiring 1,000 people in the new medical representatives. The whole idea is that we should catch the finished dosage revolution. Now, where is this finished dosage and formulation coming up? That's related with the overall India story, that healthcare is expanding. So thanks to insurance, thanks to, I would say, the new hospitals, the corporate hospitals have just started in India. So the expansion, if you try to relate healthcare versus pharma, we are going hand in hand. The more hospitals are opening, more pharmaceutical companies are coming, more new products are coming. And interestingly enough, even the digital health, which was unknown few years ago, this is growing at 10x rate. From just 2.7 billion, it is projected at 37 billion by 2030. So the massive expansion which is happening in healthcare, it is all translating in the pharma. Now, within the pharma space, I'm not being very generic. I'm not saying antibiotics will grow. Now, which segments will grow, which territories will grow, that is a matter of detail. I don't think we can detail in this platform. But primarily speaking, medical devices is an absolute new score, which nobody in the country had thought. We thought of it 20, 25 years ago, and we have been able to create a story of 500 crore rupees brand without any much advertisement. And now we are at the roots of the country. We are available in almost each and every city, all over the country, distribution. We still have a lot to cover, I would say. We still have to cover a lot in the east and south. But we are seeing the growth coming up in the medical devices. Again, medical devices is more of a compliance issue, affordability issue, detectability issue. So if we look at the pharma numbers, cardiac and diabetic, both are growing 11% CAGR in pharma market, finished dosage market. If pharma market is growing, I don't think I can't grow at the same speed in medical devices. Medical devices is much better, much higher, because more and more people are getting used to the testing. Thanks to education, thanks to awareness, thanks to digital, thanks to, I would say, mobile phones, everybody is using more and more devices for the testing. And I
Mr.
can't give
Sori,
you.
I'll interrupt over here. You know, you're talking about the medical device business, which is growing faster as compared to the pharma business. Then why the pivot from devices to pharmaceuticals? Because that's where your monopoly was. Because I mean, I was just talking to Harsh some time back that I remember covering Morepen years ago, and that was one of the only device companies that we would talk to. So why that pivot, number one? And two, when you're talking about your formulation business, which is currently valued at almost 325 crores, you're planning to grow it to around 1,000 crores, and for which you've deployed around 1,000 number in terms of sales force. So two-part question. One, why the pivot from a business which is high margin driven? And two, formulations, which is still growing, where it could be it could probably impact your margins negatively, taking into consideration the kind of expansion that you have to do. How does it augur?
Sure. I think we debate these questions every day, but I have to be a little more detailed. What's happening is that Morepen has a core competence of API. Of course, leave aside the medical devices for a moment. As an API player, we have all the international approvals. We have got FDA approved facilities. We have got latest products. We have got the product knowledge. We have got the R&D. We have got the finished dosage development. But our front end is very, if you want to use the word, weak, because we are only an API player. So I always have to go virtually, I would say, beg to the pharma companies that, okay, you take my product, launch my product. And naturally, as a B2B player, so I am at the mercy of the finished dosage player. So now, as it's a well thought of strategy that I have to go more closer to the consumer, as fast, as close as possible. So all the pharma companies in India, if we study, I would say more than 70 to 80% of the companies are finished dosage companies. So I'm not saying that there is any pivoting. We are already doing finished dosage. So now finished dosage is around 27, 28%. Obviously, we want to take to a higher value. And the finished dosage gross margin is around 70%. While API gross margin is around 40%. I'm not giving exact numbers, but between 70 and 40. So the higher value addition gives more revenue to the company, number one, and it gives higher brand value to the company. And more important is I reach directly closer to the consumer. So what is happening for the API team, I get a direct feedback from the doctor. I get a direct feedback from the customer.
Right, Mr. Suri, we are running slightly short of time, but my key question over here is, to meet a target of 15% in terms of EBITDA margins in the next 3 years, right? How are you going to achieve that? Because you're already spending in terms of expanding your formulations business, which is around 325 crores now, out of which 1,000 crores from your 5,000 will be coming in from there. So how are you going to achieve that? That is the key question, because if Morepen has to be a candidate for investors to invest in, the investor needs to understand how are you going to achieve that?
Good. I think in case you just quickly scan most of the pharma companies who are leading in the finished dosage, I would not say the big players, whether it is Cipla or Sun Pharma or Mankind or for that matter, even including Divi's, their EBITDA margins are 20 plus, sometime even 27. So we are not targeting 20 plus. I'm only saying 15 because we know that we still have a B2B portion and we still have to invest in the growth part. But finished dosage market margins are generally higher. It may take 1 or 2 years, I would say, the seeding time. But long term, we are going to get to the margin 20, but that 20 may be more than 5 years away. But the first 5 years, we just want to remain at high teens, I would say, it's 15, 16. But as compared to 27, 28, I think 15% is realistic. And it's a bundled margin. I'm not saying now for the last year, medical devices margin has already reached to 15. So we are okay with that.
Mr. Suri, exports will drive margins is what you're saying. Your US exposure is around 16%. Do tariffs impact Loom in terms of the margin trajectory or not?
Fortunately for us, our US exposure is only 6%. So we just have 120 crores of export as against 1800 plus crores of revenue total.
Okay.
So 2% export is not very high. And on the lighter side, I would say that whatever US is trying to do, whatever Mr. Trump is trying to do, so India, or as particularly I would say as Morepen, we are already there. We already have a fully integrated system. We are into API, we are into finished dosage, we are into R&D, we are doing our own market, we have our own capital consumption. So we are not much worried about the global scenario per se, because we are not even free from our existing things. We are expanding capacities to feed even the existing markets. So I don't think we are much dependent on particularly the latest market scenarios. But yes, everything counts because ultimately we have imports from China. So hopefully China should reduce prices because if nobody else is buying from them, we may be the customers. But we are keeping those things open. We are exploring. But as on today, we are expanding capacities to feed whatever we have in hand. We are expanding capacities in medical devices. We are expanding capacities in finished dosage. Was increasing the marketing teams. So far, I would say we are comfortable.
Right. Thank you so much, Mr. Suri, for breaking this down for us, giving us all of that perspective, but completely out of time on this edition of KYC. From Hiral, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.